Economic Survey 2019. Wealth creation invisible the invisible hand supported by the hand of trust. India's dominance as global economic power for three-fourths of the economic history manifest by design. Kautilya's Arthashastra postulates the role of princes in an economy. Spangler 1971. Historically, Indian economy relied on the invisible hand of the market with the support of the hand of trust. Invisible hand of the market reflected in openness in economic transactions. Hand of trust appealed to ethical, philosophical dimensions. Post liberalization, Indian economy supports both pillars of economic model advocated in our traditional thinking. Survey illustrates enormous benefits accruing from enabling the invisible hand of the market. Exponential rise in the India's GDP and GDP per capita post liberalization coincides with wealth generation. Exponential rise. Survey shows that the liberalized sectors grew significantly faster than the closed ones. Need for the hand of trust to complement the invisible hand, illustrated by financial sector performance during 2011-13. Survey posits that India's aspiration to become a 5 trillion economy depends critically on strengthening the invisible hand of the market, supporting it with the hand of trust. Strengthening the invisible hand by promoting pro business policies to provide equal opportunities for new entrants, enable fair competition and ease of doing business. Eliminate policies unnecessarily undermining markets through government intervention, enable trade for job creation. Efficiently scale up the banking sector. Introducing the idea of trust as a public good, which gets enhanced with greater use. Survey suggests that policies must empower transparency and effective enforcement using data and technology. Entrepreneurship and wealth creation at the grassroots. Entrepreneurship as a strategy to fuel productivity growth and wealth creation. India ranks third in the number of new firms created as per the World Bank. New firm creation in India increased dramatically since 2014. 12.2% cumulative annual growth rate of new firms in the formal sector during 2014-18 compared to 3.8% during the 2006 to 14 period. About 1.24 lakh new firms created in 2018, an increase of about 80% from about 70,000 in 2014. Survey examines the content and drivers of entrepreneurial activity at the bottom of the administrative pyramid over 500 districts in India. New firm creation in services is significantly higher than that in manufacturing, infrastructure, or agriculture. Survey notes that grassroots entrepreneurship is not just driven by necessity. 10% increase in registration of new firms is in a district yields a 1% increase in GDP, gross domestic district product. Entrepreneurship at district level has a significant impact on wealth creation at the grassroots. Birth of new firms in India is heterogeneous and dispersed across districts and sectors. Literacy and education in a district foster local entrepreneurship significantly. Impact is most pronounced when literacy is above 70%. New firm formation is the lowest in eastern India with the lowest literacy rate. That is 59.6% literacy rate as per the 2011 census. Physical infrastructure quality in the district influences new firm creation significantly. Ease of doing business and flexible labor regulation enable new firm creation, especially in the manufacturing sector. Survey suggests enhancing ease of doing business and implementing flexible labor laws can create maximum jobs in districts and thereby in the states. Pro business versus pro markets. Survey says that India's aspiration of becoming a $5 trillion economy depends critically on promoting pro business policy that unleashes the power of competitive markets to generate wealth. Weaning away of pro crony policy that may favor specific private interests, especially powerful incumbents. Viewed from the lens of the stock market, creative destruction increased significantly post liberalization. Before liberalization, a Sensex firm expected to stay in it for 60 years, which decreased to only 12 years after liberalization. Every 5 years, one third of the Sensex firm are churned out, reflecting the continuous influx of new firms, products, and technologies into the economy. Despite impressive progress in enabling competitive markets, pro-crony policies destroyed value in the economy. An equity index of connected firms significantly outperformed market by 7% a year from 2007 to 2010. reflecting abnormal profits extracted at common citizens' expense. In contrast, the index underperforms market by 7.5% from 2011, reflecting inefficiency and value destruction inherent in such firms. Pro-crony policies, such as a discretionary allocation of natural resources till 2011, led to rent seeking by beneficiaries, while competitive allocation of the same post 2014 ended such rent extraction. Similarly, crony lending that led to willful default, wherein promoters collectively siphoned off wealth from banks, led to losses that dwarf subsidies for rural development. Undermining markets. When government intervention hurts more than it helps. Government intervention, though well intended, often ends up undermining the ability of the markets to support wealth creation and leads to outcome opposite to those intended. Four examples of anachronistic government intervention. First, Essential Commodities Act ECA 1955. Frequent and unpredictable imposition of blanket stock limits on commodities under ECA distorts the incentives for the creation of storage infrastructure by the private sector. Movement up the agricultural value chain, development of national market for agricultural commodities. Imposition of stock limits on dal in 2006 in quarter 3, sugar in 2009 in quarter 1, and onions in September 2019 spiked up the volatility of the retail and wholesale prices of the onions. The Ministry of Consumer Affairs must examine. The Ministry of Consumer Affairs must examine whether the Essential Commodities Act is relevant in today's India. With rates having abysmally low conviction rate and no impact on prices, the ECA only seems to enable rent seeking and harassment. Survey suggests that there is clear evidence for jettisoning this anachronistic legislation. Second, drug price control under Essential Commodities Act. The regulation of prices of the drugs through the DPCO, that is Drug Price Control Order 2013, led to increase in the price of the regulated pharmaceutical drugs vis-a-vis that of an unregulated but similar drug. The increase in prices is greater for more expensive formulations than for cheaper ones and for those sold in hospitals that, rather than retail shops. These findings reinforce that the outcome is opposite to what DPCO aims to do, making drugs affordable. Government, being a huge buyer of drugs, can intervene more effectively to provide affordable drugs by combining all its purchases and exercising its bargaining power. Ministry of Health and Family Welfare must evolve non-distortionary mechanisms that utilize government's bargaining power in a transparent manner. Third point, government intervention in grain markets. Policies in the food grain market led to emergence of government as the largest procurer and hoarder of rice and wheat, crowding out of private trade, burgeoning food subsidy burden, inefficiencies in the markets affecting the long-run growth of agricultural sector. The food grains policy, the food grains policy needs to be dynamic and allow switching from physical handling and distribution of food grains to cash transfers of food coupons or smart cards. Fourth, debt waivers. Analysis of debt waivers given by states or centers. Full waiver beneficiaries consume less, save less, invest less, and are less productive after the waiver compared to the partial beneficiaries. Debt waivers disrupt the credit culture. They reduce formal credit flow to the very same farmers, thereby defeating the purpose. Survey suggests that government must systematically examine areas of needless intervention and undermining of markets, but it does not argue that there should be no government intervention. And instead, it suggests that the interventions that were apt in a different economic setting may have lost their relevance in a transformed economy. Eliminating such instances will enable competitive markets, spurring investment and economic growth, creating jobs and growth by specializing in network products. Survey says India has unprecedented opportunity to chart a China-like labor-intensive export trajectory. By integrating Assemble in India for the world into Make in India, India can raise its export market share to about 3.5% by 2025 and 6% by 2030, create 4 crore well-paid jobs by 2025 and 8 crore by 2030. Exports of network products can provide one quarter of the increase in the value added required for making India a $5 trillion economy by 2025. Survey suggests a strategy similar to one used by China to grab this opportunity. Specialization at large scale in labor intensive sectors, especially network products. Laser-like focus on enabling assembling operations at mammoth scale in network products. Export primarily to markets in rich countries, trade policy must be an enabler. Survey analyzes the impact of India's trade agreements on overall trade balance. India exports increased by 13.4% for manufactured products and 10.9% for the total merchandise. Imports increased by 12.7% for manufactured products and 8.6% for total merchandise. India gained 0.7% increase in the trade surplus per year for manufactured products and 2.3% per year for total merchandise, targeting ease of doing business in India. A jump of 79 positions to 63 in 2019 from 142 in 2014 in World Bank's ease of doing business rankings. 63rd in 63rd rankings 2019. India still trails in parameters such as starting business. Trails in parameters such as is ease of starting business, registering property, paying taxes, and enforcing contracts. Survey has numerous case studies. For merchandise exports, the logistics process flow for import is more efficient than that for the exports. Electronics exports and imports through Bangalore airport illustrate how Indian logistical processes can be world class. The turnaround time of ships in India has almost halved to 2.48 days in 2018-19 from 4.6 days in 2010-11. Suggestions for further ease of doing business. Close coordination between the logistics division of the Ministry of Commerce, close logistics division of the Ministry of Commerce and Industry, the Central Board of Indirect Taxes and Customs and Ministry of Shipping, and the different port authorities. Individual sectors such as tourism or manufacturing require a more targeted approach that maps out the regulatory and processes bottlenecks for each segment. Golden Jubilee of Bank Nationalization, taking stock. Survey observes 2019 as Golden Jubilee year of bank nationalization. Accomplishments of the lakhs of the PSB's employees cherished and an objective assessment of PSB suggested by the survey. Since 1969, India's banking sector has not developed proportionally to the growth in the size of the economy. India has only one bank in the global top 100, same as countries that are fraction of its size. Finland about 1 by 11th, Denmark about 1 by 8th, etc. A large economy needs an efficient banking sector to support its growth. The onus of supporting the economy falls on the PSBs, accounting for 70% of the market share in the Indian banking. PSBs are inefficient compared to their peer groups on every performance parameter. In 2019, investment for every rupee in PSB on average led to a loss of 23 paise, while in NPBs it led to a gain of 9.6 paise. Credit growth in PSBs has been much lower than the NPBs for the last several years. Solutions to make PSBs more efficient. Employee Stock Ownership Plan (ESOP) for PSB's employees. Representation on boards are proportionate to the stocks held by the employees to incentivize employees and align their interest with that of all stakeholders of the bank. Creation of a GSTN type entity that will aggregate data from all PSBs and use technologies like big data, artificial intelligence, and machine learning in credit decision for ensuring better screening and monitoring of borrowers, especially the large ones. Financial fragility in the NBFC sector. Survey investigates the key drivers of the rollover risk of the shadow banking system in India in light of the current liquidity crunch in the sector. Key drivers of the rollover risk: asset liability management risk, interconnectedness risk, financial and operating resilience of an NBFC, overdependence on short term wholesale funding. Survey computes a diagnostic, that is health score, by quantifying the rollover risk for a sample of HFCs and retail NBFCs which are representative of their respective sectors. The analysis of the health sector, sorry, the analysis of the health score has the following findings. The HFC sector exhibiting a declining trend post 2014, and overall health of the sector worsened considerably by the end of financial year 2019. The score of the retail NBFC sector was consistently below par for the year 2014-19. Larger retail NBFCs had higher health scores, but among medium and small retail NBFCs, the medium-sized ones had a lower score for the entire period of 2014-19. Survey suggests that the health score provides an early warning signal of impending liquidity problems. Equity markets react favorably to increase in health score of individual HFCs and retail NBFCs. The survey prescribes this analysis to efficiently allocate liquidity enhancements across firms with different health scores in the NBFC sector, thereby arresting financial fragility in a capital efficient manner. Privatization and wealth creation. Survey examines the realized efficiency gains from privatization in the Indian context and bolsters the case for aggressive disinvestment for CPSCs. Strategic disinvestment of the government shareholding of 53.29% in HPCL led to an increase of around 33,000 crore in national wealth. Survey presents an analysis of the before after performance of 11 CPSCs which underwent strategic disinvestment from 1999 to 2000 to 2003-4. Financial indicators such as net worth, net profit, return on assets, return on equity, etc., of the privatized CPSCs on an average have improved significantly. Privatized CPSCs have been able to generate more wealth from the same resources. Survey suggests aggressive investment, disinvestment to survey suggests aggressive disinvestment of CPSCs to bring in higher profitability, promote efficiency, increase competitiveness, promote professionalism. Is India's GDP growth overstated? No. GDP growth is a critical variable for decision making of investors and policymakers. Therefore, the recent debate about accuracy of India's GDP estimation following the revised estimation methodology in 2011 is extremely significant. As countries differ in several observed and unobserved ways, cross-country comparison have to be undertaken by separating the effect of other co-founding factors and also isolating effects of methodology revision alone on GDP growth estimates. Models that incorrectly overestimate GDP growth by 2.7% for India post 2011 also misestimate GDP growth over the same period for 51 out of 95 countries in the sample. Several advanced economies such as UK, Germany, and Singapore have their GDPs misestimated with incompletely specified econometric model. Correctly specified models that account for all unobserved differences and differential trends in GDP growth across countries fail to find any misestimating of growth in India or other countries. Concerns of a misestimated Indian GDP are unsubstantiated by the data and are thus unfounded. Thalynomics, the economics of a plate of food in India. An attempt to quantify what a common person pays for a thali across India. A shift in the dynamics of thali prices since 2015-16. Absolute prices of a vegetarian thali have decreased significantly since 2015-16 across India and the four regions, though the price has increased during 2019-20. Post 2015-16, average household gained close to rupees 11,000 on average per year from the moderation in prices in the case of vegetarian thali. Average household that consumes two non-vegetarian thalis gained close to rupees 12,000 on average per year during the same period. From 2006-7 to 2019-20, affordability of vegetarian thalis improved by 29% and affordability of non-vegetarian thalis improved by 18%. India's economic performance in 2019-20. India's GDP growth moderated to 4.8% in H1 of 2019-20 amidst a weak environment for global manufacturing, trade and demand. Real consumption growth has recovered in Q2, quarter 2 of 2019-20, cushioned by a significant growth in the government final consumption, growth for agriculture and allied activities, and public administration, defense, and other services in H1 of 2019-20 was higher than in H2 of 2018-19. India's external sector gained further stability in H1 of 2019-20. Current account deficit CAD narrowed to 1.5% of GDP in H1 of 2019-20 from 2.1 of 2018-19. Impressive FDI, rebounding of portfolio flows, accretion of foreign exchange reserves, sharper contraction of imports as compared to that of the exports in the H1 of 2019-20 with easing of the crude prices. Headline inflation expected to decline by end year, increased from 3.3% in H1 of 2019-20 to 7.3% in December 2019-20 due to temporary increase in food inflation. Rise in CPI core and WPI in December 2019-20 suggests building of demand pressure. Deceleration in GDP growth can be understood within the framework of a slowing cycle of growth. Financial sector acted as a drag on the real sector, investment growth consumption. Reforms undertaken during 2019-20 to boost investment, consumption and exports. Speeding up the insolvency resolution process under the IBC, easing of credit, particularly for the stressed real estate and NBFC sectors. Announcing the National Infrastructure Pipeline 2019 to 25, survey expects an uptick in the GDP growth in H2 of 2019-20. 5% of GDP growth for 2019-20 based on CSO's first advanced estimates. Expeditious delivery on reforms for enabling the economy to strongly rebound in 2021. Fiscal developments. Revenue receipts, revenue receipts registered a higher growth during the first 8 months of 2019-18 compared to same period last year, led by considerable growth of non-tax revenue. Gross GST monthly collection have crossed the mark of rupees 1 lakh crore for a total of 5 times during 2019-20 up to December 2019. Structural reforms undertaken in taxation during the current financial year. Change in corporate tax rate. Measures to ease the implementation of GST. Fiscal deficit of states within the targets set out by the FRBM Act. Survey notes that the general government, center plus states, general government, that is center plus states, has been on the path of fiscal consolidation. External sector, balance of payment, BOP. India's BOP position improved from US dollar 412.412.9 billion of forex reserves in end March 2019 to US 433.7 billion in end September 2019. CAD narrowed from 2.1 to 1.5% in GDP in H1 of 2019-20. Foreign reserves stood at US dollar 461.2 billion as on 10 January 2020. Global trade in sync with an estimated 2.9% growth in global output in 2019. Global trade is estimated to grow at 1% after having peaked in 2017 at 5.7%. However, it is projected to recover to 2.9% in 2020 with recovery in the global economic activity. India's merchandise trade balance improved from 2009 to 14 and 2014 to 19, although most of the improvement in the latter period was due to more than 50% decline in the crude prices in 2016-17. India's top 5 trading partners continue to be USA, China, UAE, Saudi Arabia, and Hong Kong. USA, China, UAE, Saudi Arabia, and Hong Kong. Exports. Top exports item: petroleum products, precious stones, drug formulations, biologicals, gold, and other precious metals. Largest exports destination in 2019-20. April November UAE, USA, followed by UAE, then China, then Hong Kong. The merchandise exports to GDP ratio declined. The merchandise exports to GDP ratio declined, entailing a negative impact on BOP position. Entailing a negative impact on BOP position. Slowdown of the world output had an impact on reducing the export to GDP ratio, particularly from 2019 to H1 of 2019-20. Growth in non-POL exports dropped significantly from 2009-14 to 2014-19. Imports. Top import item: crude petroleum, gold, petroleum products, coal, coke, and briquettes. India's imports continue to be largest from China, followed by USA, then UAE, then Saudi Arabia. Merchandise imports to GDP ratio declined in for India, entailing a net positive impact on the BOP situation. Large crude oil imports in the import basket correlates India's total imports and crude policy prices. As crude prices rises, so does the share of the crude in the total imports, increasing the imports to GDP ratio. Significant gold imports also correlate India's total imports with gold prices. However, share of gold imports in total imports remained the same during 2018-19 and the first half of the 2019-20, despite an increase in the prices, possibly due to increase in the import duty that reduced the import of the gold. Non-coal, non-gold imports are possibly correlated with GDP growth. Non-coal, non-oil imports fell as a proportion of GDP from 2009-14 to 2014-19 when GDP growth accelerated. This may be because of consumption-driven growth, while in investment rate declined, lowering non-coal, non-gold imports. Continuous decline in investment rate decelerated GDP growth, weakened consumption, dampened the investment outlook, which further reduced GDP growth and along with it non-coal, non-gold imports as a proportion of GDP from 2018-19 to H1 of 2019-20. Under trade facilitation, India improved its ranking from 143 in 2016 to 268 to 68 in 29 under the indicator trading across borders monitored by World Bank in its ease of doing business report. Trading across borders monitored by World Bank. Logistics industry in India currently estimated to be around US dollar 160 billion, expected to touch 215 billion US dollar by 2020, according to World Bank's Logistic Performance Index. World Bank's Logistic Performance Index. India ranks 44th in 28 globally, up from the 54th rank in 2014. Net FDI flows continue to be buoyant in 2019-20, attracting US dollar 24.4 billion in the first 8 months, higher than the corresponding period of 2018-19. Net FPI in the first 8 months of 2019-20 stood at US dollar 12.6 billion. Net remittances from the Indians employed overseas continue to increase, receiving US dollar 38.4 billion in H1 of 2019-20, which is more than 50% of the previous year's level. External debt remains low at 20.1% of the GDP as at and September 2019. After a significant decline in 2014-15, India's external liabilities, that is debt and equity to GDP. India's external liabilities, that is debt and equity. So India's external liabilities to GDP increased at the end zone. Debt and equity. India's external liabilities are debt and equity. Debt and equity. 2019 primarily by increase in FDI portfolio flows and external commercial borrowings. Primarily by FDI portfolio and external commercial borrowings. Monetary management and fiscal intermediation. Monetary policy remained accommodative in 2019-20. Repo rate was cut by 110 basis points in 4 consecutive MSP meetings in the financial year due to slower growth and lower inflation. However, it was kept unchanged in the fifth meeting held in December 2019. In 2019-20, liquidity conditions were tight for initial 2 months, but subsequently it remained comfortable. The gross non-performing advances ratio remained unchanged for the scheduled commercial banks at 9.3% between March and September 2019. Increased slightly for the non-banking financial corporations from 6.1% in the March 2019 to 6.3% in September 2019. Credit growth. The financial flows to the economy remained constrained as credit growth declined for both banks and NBFCs. Bank credit growth moderated from 12.9% in April 2019 to 7.1% as on December 2019. Capital to risk-weighted asset ratio of scheduled commercial banks increased from 114.3% to 15.1% between March 2019 and September 2019. Prices and inflation. Inflation trends. Inflation witnessing moderation since 2014. Consumer Price Index CPI inflation increased from 3.7% in 2018-19 April to December 2018 to 4.1% in 2019-20 April to December 2019. WPI inflation fell from 4.7% in 2018-19. Drivers of CPI combined inflation. During 2018-19, the major driver was the miscellaneous group. During 1920, that is April-December, food and beverages were the main contributor to the drivers of CPI combined. Among food and beverages, inflation in vegetables and pulses was particularly high due to effect and low base effect and production side disruptions like untimely rain. Cobb-Bebb phenomena for pulses. Farmers base their sowing decisions on prices witnessed on low base effect. Cobb-Bebb phenomena for pulses. Farmers base their sowing decision on prices witnessing in the previous marketing period. Measures to safeguard farmers like procurement under the Price Stability Fund (MSP) need to be made more effective. Divergence between retail and wholesale prices observed for essential agricultural commodities in 4 metropolitan cities of the country from 2014-19. Divergence particularly high for vegetables like onions and tomato. This may be due to the presence of intermediaries and high transaction costs. Volatility of prices. Volatility of prices for most of the essential food commodities, with the exception of some of the pulses, has actually come down in the period 2018 for 2014-19 as compared to the period 2009-14. Lower volatility might indicate the presence of better marketing channels, storage facilities, and effective MSP system. Regional variations. CPI combined inflation has been highly variable across states, ranging between minus 0.04% to 8.1% across states and UTs in financial year 2019-20 April to December. In most states, CPI combined inflation in rural areas is lower than the CPI combined inflation in urban areas. Rural inflation has been more variable across states than urban inflation. Inflation dynamics. Convergence of headline inflation towards core inflation as per the CPI combined data from 2012 onwards. Sustainable development and climate change. India moving forward on the path of SDG implementation through well-designed initiatives. SDG India Index. Himachal Pradesh, Kerala, Tamil Nadu, Chandigarh are frontrunners. Assam, Bihar, and UP come under the category of aspirants. India hosted COP14 to UNCCD, which adopted the Delhi Declaration, investing in land and unlocking opportunities. COP25 of UNFCCC at Madrid. India reiterated its commitment to implement Paris Agreement. COP25 decisions include efforts for climate change mitigation, adaptation, and means for implementation from developed countries parties to developing country parties. Forest and tree cover increasing and has reached 80.73 million hectare, 24.56% of the geographical area of the country, 24.56%. Burning of agricultural residue leading to rise in the pollution levels and deterioration of the air quality is still a major concern, through the total number of burning events recorded reduced due to various efforts taken. International Solar Alliance enabler by institutionalizing 30 fellowships from the member countries. Facilitator by getting the lines of the credit worth $2 billion from Exim Bank of India and 1.5 billion from the AFD France. Incubator by nurturing initiatives like the Solar Risk Mitigation Initiative. Accelerator by developing tools to aggregate demand for 1000 megawatt solar and 2.7 lakh solar water pumps. Agriculture and food management. Largest proportion of the India's population depends directly or indirectly on agriculture for employment opportunities as compared to any other sector. The share of agriculture and allied sectors in the total GVA, gross value added, of the country has been continuously declining on account of relatively higher growth performance of non-agriculture sectors, a natural outcome of development processes. Gross value added at basic prices of for 2019-20 from agriculture, forestry and fishing sector is estimated to grow by 2.8%. Agricultural productivity is also constrained by lower level of mechanization in agriculture, which is about 40% in India, much lower than China, that is 59.5%, and Brazil 75%. Skewed pattern of regional distribution of agricultural credit in India. Low credit in hilly, eastern and northeastern states, less than 1% of total agriculture credit disbursement. Livestock income has become an important secondary source of income for millions of rural families. An important role in achieving the goal of doubling farmers' income, livestock sector has been growing at the cumulative annual growth rate of 7.9% during the last 5 years. During the last 6 years, ending 2017-18, food processing industries sector has been growing. An average annual growth rate of around 5.06% constitutes as much as 8.83% and 10.66% of GVA in manufacturing and agriculture sector respectively in 2017-19, 2017-18 at 2011-12 prices. While interests of the vulnerable sections of the population need to be safeguarded, survey emphasizes on sustainability of food security operations by addressing the burgeoning food subsidy bill, revisiting the rates and coverage under NFSA. Industry and infrastructure. The industrial sector, as per the index of industrial production, registered a growth of 0.6% of in 2019-20 April-November as compared to 5% during the 2018-19 April-November. Fertilizer sector achieved growth of 4% during 2019-20 April-November as compared to minus 1.3% during the 2018-19 April-November. Steel sector achieved a growth of 5.2% during 2019-20 April-November as compared to 3.6% during 2018-19 April-November. Total telephone connections in India touched 119.43 crore, 119.43 crore as on September 30, 2019. The installed capacity of power generation has increased to 364,960 megawatt, 3,64,960 megawatt as on 31 October 2019, 31st October 2019 from 3,56,1100 megawatt as on 31st March 2019. Report of the Task Force on the National Infrastructure Pipeline released on 31st December 2019 has projected total infrastructure investment of rupees 102 lakh crore during the financial period 2020-25 in India. Services sector. Increasing significance of services sector in the Indian economy. About 55% of total size of the economy and the GVA growth. Two-thirds of the total FDI flows into India. About 30% of total exports. More than 50% of the GVA in 15 out of the 33 states and UTs. GVA growth of the services sector moderated in 2019-20 as suggested by various high-frequency indicators and sectoral data such as air passenger traffic, port and shipping freight traffic, bank carried, etc. On the bright side, FDI into services sector has witnessed a recovery in early 2019-20. Social infrastructure, employment and human development. The expenditure of social services like health and education and others, when the central and state governments as a proportion of GDP increased from 6.2% in 2014-15 to 7.7% in 2019-20. India's ranking in the Human Development Index improved to 129 from 130 with only 1 point. With 1.3% average annual HDI growth, Human Development Index growth, India is among the fastest improving countries. Gross enrollment ratio at secondary, higher secondary and higher education levels needs to be improved. The share of regular wage salaried employees has increased by 5 percentage points from 18% in 2011-12 to 23% in 2017-18. A significant jump of around 2.62 crore new jobs with 1.21 crores in rural areas and 1.39 crore in urban areas in this category. Total formal employment in the economy increased from 8% in 2011-12 to 9.98% in 2017-18. Gender disparity in India's labor market divided due to decline in female labor force participation, especially in rural areas. Around 60% of the productive age, that is 15 to 59 group, engaged in full-time domestic duties. Access to health services inter alia through Ayushman Bharat and Mission Indradhanush across the country has improved. Mission Indradhanush has vaccinated 3.39 crore children and 87.18 lakh pregnant women of 680 districts across the country. About 76.7% of the households in the rural and about 96% in the urban areas had houses of Pakka structure. A 10-year rural sanitation strategy. 10-year rural sanitation strategy. A 10-year rural sanitation strategy launched to focus. 10-year rural sanitation strategy. 10-year rural sanitation strategy 2019-29 launched to focus on sustaining the sanitation behavior change and increasing access to solid and liquid waste management.